In the summer of 1941, an 11-year-old boy named Warren Buffett walked into a brokerage office in Omaha, Nebraska. With trembling hands, he clutched 2 wrinkled dollar bills, ready to make his very first investment. His father, Howard, was a stockbroker, and young Warren spent hours studying the numbers on the board. He bought 3 shares of City Service Preferred for $38 each, using every penny he had saved. The stock crashed soon after, dropping below $30. But Warren refused to sell. He waited patiently, and when the price finally recovered, he sold for a small profit of $5. A valuable lesson was learned that day. Determined to understand business, Warren read every book on investing he could find. By age 14, he had built a paper route empire, earning $175 a month, more than his teachers made. At age 14, Warren filed his first tax return, carefully deducting his bicycle and watch as business expenses. He invested his savings in a 40-acre farm, which he rented to a tenant farmer for a steady income. By age 19, Warren had saved over $9,000, a fortune for a teenager in 1949. He enrolled at the University of Nebraska, juggling classes with his growing businesses while studying finance with relentless passion. After graduating, Warren applied to Harvard Business School, but was rejected. The rejection stung deeply, but it redirected him to Columbia Business School, where a legendary professor named Benjamin Graham was teaching. Benjamin Graham, the father of value investing, taught Warren that buying $1 for 50 cents was the key to wealth. Graham's philosophy of finding undervalued companies became the foundation of Buffett's entire investment strategy. Though Warren absorbed every word Graham said. He offered to work at Graham's firm, Graham-Newman Corporation, for free. But Graham initially refused, preferring only Jewish analysts, a prejudice that stunned and disappointed the young investor. Undeterred, Warren returned to Omaha and started his own investment partnership in 1956 with $100,000 from 7 family members and friends. He was just 25 years old and hungry for success. The Buffett partnership started small, operating out of Warren's bedroom. He analyzed hundreds of companies, searching for those selling below their intrinsic value. His first year returns beat the market by over 10%. Year after year, Warren consistently outperformed the stock market. By 1960, the partnership had grown to over $1 million in assets. His reputation as a brilliant investor spread throughout Omaha's business community. In 1962, Warren discovered a struggling textile mill called Berkshire Hathaway. He began buying shares at bargain prices, eventually taking control of the company. Little did he know this would become his greatest investment vehicle. The textile business was dying, but Warren discovered something more valuable: the company's insurance subsidiary. He realized insurance provided something extraordinary called float, money collected as premiums that could be invested before claims were paid. In 1965, Warren took full control of Berkshire Hathaway. He fired the dishonest management and installed his own team. The stock price, which had been $8, began a climb that would eventually reach over $300,000 per share. By 1969, Warren decided to dissolve the Buffett partnership. He had compounded money at an astonishing rate of over 30% annually for 13 years. His partners had become wealthy beyond their wildest dreams. Warren's personal wealth reached $25 million. But instead of retiring, he focused entirely on Berkshire Hathaway. The insurance float kept growing, giving him more and more capital to invest in undervalued companies. In 1973, the stock market crashed, and panic spread everywhere. While others sold in fear, Warren saw opportunity. He began buying shares of the Washington Post Company, investing $10 million into the struggling newspaper giant. The Washington Post investment grew to over $100 million in just a few years. Warren became close friends with Katharine Graham, the paper's publisher. He mentored her on business while she taught him about journalism and power. In 1976, Warren made another brilliant move. Geico in more. Geico, the auto insurer that had served him since college, was on the brink of bankruptcy with its stock at $2. Warren invested $4 million and saved the company. The Geico investment eventually grew to over $4 billion, a thousand-fold return. Warren had saved thousands of jobs and made billions for Berkshire shareholders. His reputation as the Oracle of Omaha began to form. By 1980, Berkshire's stock had reached $300 per share. But Warren was just getting started. He had built a fortress of insurance companies that generated billions in float money, waiting to be deployed in the next crisis. In 1983, Warren took a bold step. Not out. He bought Nebraska Furniture Mart from Rose Blumkin, a 90-year-old immigrant who had built the business from nothing. Warren wrote her a check without any audit or contracts, trusting her word. Warren's integrity became legendary. He believed in buying wonderful businesses at fair prices rather than fair businesses at wonderful prices. This simple philosophy guided every decision he made, from See's Candies to Buffalo News. By 1985, Berkshire stock had split and soared past $2,000 per share. But Warren still lived in the same modest house in Omaha he had bought in 1958 for $31,000. He had no interest in flashy wealth. In 1987, the stock market crashed on Black Monday. While Wall Street panicked, Warren calmly bought stocks. He had learned from his mentor Graham that fear creates opportunity. Within 2 years, his purchases had doubled in value. In 1988, Warren made his most famous investment. He began secretly buying shares of Coca-Cola, eventually purchasing 7% of the company for just over $1 billion. Wall Street wondered who was buying so much Coke stock. The Coca-Cola investment soared to over $5 billion within a decade. Warren had turned $1 billion into $5 billion, simply by recognizing a timeless brand with global dominance. The world began calling him the greatest investor of all time. By 1990, Warren Buffett was a billionaire many times over. His annual letters to Berkshire shareholders became must-read wisdom for investors worldwide. His down-to-earth writing style explained complex finance with simple, unforgettable metaphors. In 1993, Warren bought Dexter Shoe Company for $433 million in Berkshire stock. It turned out to be one of his worst investments, losing nearly all its value. But Warren openly admitted his mistake to shareholders. Warren's honesty about failures actually increased investor trust. He taught that admitting mistakes was a strength, not a weakness. Unlike many CEOs, he never hid his errors or blamed others for bad outcomes. In 1996, Berkshire Hathaway's Class A stock reached $30,000 per share. Warren created a cheaper Class B stock so ordinary people could invest. He believed everyone deserved access to Berkshire's success. Warren never used debt to buy stocks. He kept massive cash reserves at Berkshire, ready for emergencies. When the market crashed, he would be the one with money to lend while others desperately needed it. In 1998, Warren acquired General Reinsurance Corporation for $22 billion. The deal added massive float to Berkshire's insurance operations. With over $40 billion in cash, Warren was ready for any opportunity. During the dot-com bubble of the late 1990s, Warren refused to invest in technology companies he didn't understand. Critics called him old-fashioned and out of touch. But he calmly replied that he preferred certainty over hype. When the dot-com bubble burst in 2000, trillions of dollars evaporated. But Berkshire Hathaway's stock actually rose. Wall Street finally understood that Warren's boring, old-fashioned investing strategy had beaten the flashy tech speculators again. By 2003, Warren's personal fortune reached $36 billion. He was the second richest man in the world. But he still drove his own car, lived in the same house, and ate at McDonald's for breakfast every morning. In 2006, Warren made a stunning announcement. He pledged to give away 85% of his fortune, about $37 billion, to the Bill and Melinda Gates Foundation. It was the largest charitable donation in human history. Warren explained that giving away his wealth was the logical thing to do. He said a rich person should leave their children enough to do anything, but not enough to do nothing. His children would not inherit his billions. In 2008, the global financial crisis struck. Banks were collapsing everywhere. While the world panicked, Warren stepped in with calm authority, investing $5 billion in Goldman Sachs at favorable terms when they desperately needed cash. The Goldman Sachs investment earned Berkshire $5 billion in profit within a few years. Warren had done it again, buying when there was blood in the streets. His famous rule echoed across Wall Street with renewed respect. In 2010, Warren and Bill Gates launched the Giving Pledge, encouraging billionaires worldwide to donate most of their wealth to charity. Within a decade, over 200 billionaires from 23 countries had signed the pledge. By 2011, Berkshire stock had reached $120,000 per share. Warren's personal wealth peaked at over $70 billion. Yet he still answered his own phone, wrote his own letters, and had no personal staff. In 2015, Berkshire Hathaway celebrated its 50th anniversary. One share bought in 1965 for $18 was now worth over $200,000. An investment of $1,000 was now worth over $11 million. Warren shocked the world in 2016 when Berkshire bought Apple shares for over $1 billion. The old man who had avoided technology for decades was now betting on the iPhone maker. Critics questioned his judgment once again. The Apple investment turned out to be brilliant. Berkshire's stake grew to over $160 billion, becoming Warren's most profitable investment ever. At 90 years old, he was still learning and adapting. In 2020, when the COVID-19 pandemic crashed markets, Warren sold his airline stocks at a loss. Many mocked him for selling too early. But he used the cash to buy back Berkshire's own shares, which soared in value. By 2021, Berkshire Hathaway had grown to over $600 billion in market value. Warren Buffett, now 91, was still chairman. He had never stopped working, never stopped reading, and never stopped learning. Warren's daily routine remained astonishingly simple. He read 500 pages every day, consuming annual reports and newspapers. He believed knowledge built up like compound interest, slowly at first, then exponentially. The secret to Warren's success was not a system or formula, but his temperament. He simply refused to panic when others panicked. He believed in America's long-term future and bought wonderful companies to hold forever. Warren famously said that his favorite holding period is forever. He never tried to time the market. Instead, he bought businesses he understood, with strong competitive advantages, run by honest and capable management teams. In 2022, with inflation soaring and markets falling, Warren's cash pile reached a record $149 billion. He was once again waiting patiently for the perfect opportunity, like a lion watching its prey. By 2023, the $2 young Warren had invested had grown into over $100 billion of personal wealth, with over $600 billion under Berkshire's management. The mathematical miracle of compound interest had worked its magic. Warren's life teaches us that wealth is built slowly, through discipline, patience, and continuous learning. He started with nothing but curiosity and a paper route. He became the world's greatest investor without ever losing his humanity. The most remarkable thing about Warren Buffett is not how much money he made, but how he lived. He remained humble, generous, and honest, despite becoming the richest man on earth. That is his true legacy. Warren once said that money is not the score. Life is the score. He defined success not by wealth, but by the number of people who love you. And billions of people around the world love the Oracle of Omaha. From a boy with $2 to a man with over 100 billion, Warren Buffett's journey proves one thing. Compound interest works miracles, but only when combined with patience, integrity, and an unwavering belief in the future. Let us begin at the very beginning. Warren Edward Buffett was born on August 30th, 1930, in Omaha, Nebraska. He was the second of 3 children and the only son of Howard and Layla Buffett. As a toddler, Warren showed an unusual fascination with numbers. He would spend hours writing down numbers and calculating sums. His mother Layla noticed that he was not like other children his age. At age 6, Warren started a small business selling chewing gum door to door. He bought packs for 5 cents and sold each stick for a penny. Even then, he understood the concept of profit margin. By age 7, Warren had expanded to selling Coca-Cola bottles. He would buy a 6-pack for 25 cents and sell each bottle for 5 cents, making a 5-cent profit. The Coca-Cola brand was already catching his attention. At 8 years old, Warren read a book from the Omaha Public Library, titled 1,000 Ways to Make $1,000. The book promised practical methods to earn money, and young Warren devoured every page with burning ambition. Inspired by the book, 9-year-old Warren started keeping track of stock prices on a blackboard. He would write down the daily movements of companies he heard about, building what would become a lifelong habit of observation. At age 10, Warren's father took him on a trip to New York City. They visited the New York Stock Exchange. Young Warren was mesmerized by the chaos and energy of the trading floor, knowing instantly he belonged there. A few months before his 11th birthday, Warren saved enough money to take the leap. He walked into Harris Upham Brokerage on Farnham Street in Omaha, Tatanian. The $2 in his pocket represented months of hard work and sacrifice. The brokers inside were surprised to see a child walk in alone, but young Warren ignored their amused stares. He confidently approached the counter and asked to buy 3 shares of Citi Service preferred stock for himself. The broker processed the order with a chuckle. Warren handed over his carefully saved money and received a stock certificate in return. He held it in his hands like a treasure map to a future he could already see. The year 1942 brought dark news. World War II was raging across the globe, but young Warren kept buying and selling, unaffected by the global chaos. He understood something most adults could not grasp, that fear creates opportunity. By 1943, 12-year-old Warren had started multiple businesses simultaneously. He ran a pinball machine operation, delivered newspapers before dawn, and collected rare stamps for resale. His mind was always calculating the next profit. In 1944, Warren filed his first income tax return at age 14. He deducted his bicycle at $35 and his wristwatch at $10 as business expenses. The government accepted his deductions without question. By age 15, Warren and a friend bought a used Rolls-Royce for $350. They rented it out for weddings and special occasions, charging $35 per use. The car paid for itself within months. At 16, Warren had accumulated the equivalent of $53,000 in today's money. He bought a 40-acre farm in Nebraska, hiring a tenant farmer to work the land. He was already a landlord before getting his driver's license. In 1947, Warren graduated from high school at age 17. His yearbook photo showed a serious young man with a caption that read, "Likes math and history." But everyone who knew him understood he was destined for something far greater. Warren wanted to skip college and go straight into business, but his father insisted he attend the University of Pennsylvania's Wharton School. Reluctantly, Warren enrolled, finding most classes too slow and theoretical for his practical mind. After 2 years at Wharton, Warren transferred to the University of Nebraska to finish his degree faster. He completed his coursework in just 1 year while running 3 businesses and a farm simultaneously, graduating at age 19. Warren applied to Harvard Business School with confidence but was rejected during his interview. The interviewer said he looked too young and sounded like a know-it-all. The rejection devastated Warren but fueled his determination to prove everyone wrong. Benjamin Franklin once said that time is money. Warren Buffett took this literally and made every second count for over 9 decades. He never wasted a moment, always reading, thinking, or analyzing something of value. Graham's classes at Columbia transformed Warren's understanding of the stock market. He learned that buying stocks meant buying pieces of real businesses, not just pieces of paper. This fundamental truth shaped his entire investment philosophy. After Columbia, Warren offered to work for Graham Newman for free. Graham famously said that Warren was overqualified, but eventually, Graham hired him for a tiny salary of $12,000 a year. Warren accepted without negotiation. Working at Graham Newman taught Warren how to analyze businesses with mathematical precision. He learned to calculate intrinsic value, margin of safety, and the difference between price and worth. These became his lifelong investment tools. When Graham retired in 1956 and dissolved his partnership, Warren returned to Omaha. He was 25 years old with $174,000 in personal savings. The time had come to build his own investment empire. He started the Buffett Partnership with 7 investors who trusted him completely. His initial capital was $100,000. Warren promised nothing, except that he would invest according to the principles Benjamin Graham had taught him. The partnership operated from Warren's bedroom and a small spare room. He read annual reports, called company executives, and visited businesses personally. His wife Susie sometimes answered the phone while he analyzed balance sheets late into the night. In 1957, the partnership's first full year, Warren achieved a return of over 10%, while the general market dropped by 8%. His investors were thrilled. Word about the brilliant young investor in Omaha began to spread. By 1962, the partnership had grown to over $7 million. Warren moved his office to a small room in a building in downtown Omaha. He hired a single employee, a secretary named Billy, who would work with him for decades. Warren was a genius at finding hidden value. He discovered a company called Dempster Mill Manufacturing, a farm equipment maker selling below its net current asset value. He bought control and eventually liquidated it for a massive profit. In 1963, Warren made his boldest move yet. He secretly began buying shares of American Express after a scandal called the salad oil swindle had crushed its stock price. The company was fundamentally sound, but deeply hated by the market. Warren personally visited American Express offices and even observed people using traveler's checks in restaurants. He realized the brand was still trusted by millions despite the scandal. He invested 40% of the partnership into the stock. Within 5 years, American Express stock quintupled. Warren had turned $5 million into over $25 million. The investment established his reputation as someone who could see value where others saw only disaster. By 1965, the partnership had grown to over $26 million. Warren's personal share was worth over $6 million. Yet he still lived frugally, driving a used car and wearing suits that his wife bought off the rack. Warren's investment in Berkshire Hathaway began in 1962, when he noticed the textile mill was selling below its working capital. He started buying shares, never dreaming that this failing textile company would become his billion-dollar empire. In 1965, Warren took control of Berkshire Hathaway and fired the dishonest CEO, Ken Chase. He appointed a new management team and began slowly shifting the company's focus from textiles to insurance and investments. The partnership continued its extraordinary run. From 1957 to 1969, the Buffett partnership achieved a compounded annual return of over 30%. An investment of $10,000 would have grown to over $150,000. In 1969, Warren made a shocking decision. He dissolved the partnership, returning all money to his investors. He explained that he could no longer find undervalued stocks in the overheated market. His integrity was more important than fees. Warren's personal wealth from the partnership was $25 million. He kept only Berkshire Hathaway, which by then had grown from a tiny textile stock into an $8 million holding company poised for greatness. By 1972, Warren had transformed Berkshire into a pure investment vehicle. He purchased See's Candies for $25 million. The California candy maker would go on to earn over $2 billion for Berkshire in the decades ahead. See's Candies taught Warren that a wonderful brand with pricing power could generate enormous returns. The lesson shaped his later investments in Coca-Cola, Gillette, and American Express. He called it the most important investment of his career. In 1976, Warren met Bill Gates for the first time at a dinner party. The two computer enthusiasts from different generations hit it off instantly and spent hours talking about technology, business, and the future of America. Their friendship would become one of the most important in business history. Gates admired Buffett's wisdom, and Buffett admired Gates's technological vision. They played golf together, traveled together, and eventually gave away their fortunes together. Warren's investment in the Washington Post in 1973 proved masterful. He bought the stock when the company was worth only $80 million. By 1985, the Post was worth over $1 billion. His $10 million turned into over $100 million. In 1985, Warren closed the original Berkshire Hathaway textile mill. The business that gave birth to his empire was no longer profitable. He sold the machinery and redirected capital into far more promising investments. By 1986, Berkshire stock had reached an incredible $3,000 per share. An original investment of $18 in 1965 was now worth $3,000. The miracle of compounding was just beginning to reveal its power. Warren's approach to management was unique. He hired the best people and then got out of their way. He never told his managers what to do because he had already chosen people who were better at running their businesses than he was. Warren famously said that when a management team with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. He only bought great businesses. In 1993, Warren Buffett met his future wife Astrid Manx at a charity event. After Susie's passing in 2004, Warren and Astrid married in 2006. The couple lived quietly in Omaha, maintaining Warren's famously modest lifestyle. During the 2008 financial crisis, Warren wrote an op-ed in the New York Times saying he was buying American stocks. He declared his personal account held only United States dollars, and he was investing in America's future with confidence. Warren's investments during the crisis included Goldman Sachs, General Electric, and Bank of America. He negotiated preferred shares with guaranteed dividends, earning Berkshire billions while providing stability to panicked financial institutions. In 2010, Warren Buffett joined the Giving Pledge himself, formalizing his commitment to give away 99% of his wealth. He told Forbes magazine that the best thing to leave children is enough money to do anything but not enough to do nothing. By 2013, Berkshire Hathaway owned over 80 businesses outright. From insurance to railroads, from utilities to manufacturing, the company generated over $180 billion in annual revenue under Warren's steady leadership. In 2015, Warren wrote his famous shareholder letter explaining the power of Coca-Cola. He calculated that Berkshire had earned over $100 billion from dividends and stock gains, simply by buying and holding great American brands. Warren's daily breakfast routine became famous. He would stop at McDonald's every morning, ordering a sausage biscuit if the market was down and a bacon, egg, and cheese if it was up. He never spent more than $3.17. In 2016, Warren shocked the investment world by buying nearly 10% of Apple. The man who had famously avoided tech stocks for decades was betting his biggest bet ever on a company everyone already owned. His timing was perfect. By 2017, the Apple investment had made Berkshire over $40 billion in profit. Warren admitted he should have bought it years earlier. His humility in admitting mistakes and learning new things kept him sharp even in his late 80s. In 2020, during the pandemic, Warren made a surprising pivot. He sold Berkshire's entire airline portfolio at a loss and built an even larger cash pile. By 2021, that cash reached $144 billion, ready for the next opportunity. Warren's annual shareholder meetings became legendary events. Tens of thousands of investors traveled to Omaha from around the world to hear him speak for hours, answering questions with wit, wisdom, and unexpected humor. Warren Buffett transformed from a curious boy with $2 into the most successful investor in history. But he never forgot where he came from. He still lives in the same house, drives a reasonable car, and eats at Dairy Queen with friends. The Oracle of Omaha proved that ordinary people can achieve extraordinary results through discipline, patience, and continuous learning. His $2 became the seed that grew into a $100 billion tree through the miracle of compound interest. Warren once said that someone is sitting in the shade today because someone planted a tree a long time ago. His entire life has been about planting trees for future generations. And the shade he created covers the entire world. The story of Warren Buffett is not about money. It is about the power of a curious mind, an honest heart, and an unwavering belief in the future. From $2 to $100 billion, his journey reminds us that anything is possible. So the next time you see a $2 bill, remember the boy from Omaha who turned $2 into $100 billion. He did it by reading, learning, waiting patiently, and never losing sight of what truly matters in life.